Afternoon, ladies and gentlemen. Welcome to this week's edition of CR's Weekly Market Review. This is going to be a special edition. We're going to have, or rather we do have, two guest speakers with us today. One is Mr. Song Seng Woon, is an economist at CGS Securities, and the other would be Terence Wong of Azure Capital. Okay, very warm welcome to both of you gentlemen. Happy New Year. How has your New Year been the last few days?
Happy New Year, Ben.
Yeah, Happy New Year to you too, and Happy New Year to
and
everybody.
Uncle Song.
New Year, we have to party.
So as usual, I guess this is an excuse for us to go out drinking later, but okay, we're in different offices. All right. So, ladies and gentlemen, we're going to have the presentation by Mr. Song first on the economic outlook, and after we have got Mr. Terence Wong to again present his outlook on the year 2022. So, for those of you out there who are wondering what may happen in the year of the tiger, we have got our speakers here to hopefully give you some guidance and what you may expect. And we're going to leave a few minutes at the end for our questions from the floor. All right, so with that, let's get going. Can I invite Mr. Song to present his view on what may happen in the year 2022?
Okay, thank you, and good afternoon, everybody. Happy New Year once again. Year of Tiger coming up. Hopefully, the tiger is fierce enough to bite and chase the virus away. Actually, I'm more keen to hear what Terence has to say about outlook, etc. Because on the economy side, I think all I can say probably can be wrapped up in a couple of sentences. Is what I put on the slide over here. In that we had hope last year to be much better, not too bad, but obviously the COVID flare up, basically create a few more headaches, which is why we still couldn't travel, but with great confidence. So hopefully this year that might happen. Hopefully second half of the year or beyond, or certainly 2023 to be better, as they say. Okay, now before we get on to the more fun bit with Terence and outlook and stocks and trends to watch out for, I'll give, I suppose, a quick rundown of the economy. Okay, next slide, please. Right, I think it's basically just this in terms of it was an uneven recovery. 2020, obviously we know what happened. 21 was supposed to be a recovery year on optimism, on treatment, etc. But the occasional flare up, if you still remember Alpha, Delta, we ran out, I don't know how many names. Obviously in Q4 we have Omicron, and that is still creating a few headache for us and around the region and the rest of the world. I suppose if I were to put Omicron relative to what we have seen previously, if we were to look at hospitalization rate in Singapore, fatality rate over recent weeks, it has stabilized at single digit, 1 or 2. We still don't want any deaths associated with COVID, but there are still 1 or 2, which I suppose compared to Q4 last year, it has come a long way. So finger crossed, that suggests that we may still be able to gradually open up, which means that in-person activity picks up with treatment hope, with vaccines, etc. Maybe things will look indeed better and betterer as we head into the second half, and I suppose more confidently about 2023. So we have seen growth up and down, and it certainly cooled down somewhat in Q4. Next slide, please. Okay, and this is, I suppose, a good sort of a picture to just describe how things were over the past 3 years. We are into the third year of the pandemic. Hope and optimism prevail. As you can see, we shouldn't just assume it will be a straight line recovery. Indeed, because of Omicron, we may see Q1 growth being pinned back in the region. Certainly, we have seen China, for instance, seeing the momentum slowed somewhat, and we have certainly seen them taking more aggressive steps, especially since there are quite a few key events coming out, starting with the Beijing Olympics. You have the Congress, you have the Asian Games also coming out. So I can see that describe the last 3 years of a not straight forward sort of recovery path. Next, please. So if we were to see China released their Q4 GDP this morning. 2021 growth was just over 8%, 8.1, I think. Q4 slowed down, as we've seen from this chart over there. Not as bad as analyst consensus. It came in around 4%, mainly because I think the goods producing side, despite supply constraint, despite pressure points, still managed to add to growth. Export sector very strong. If not for supply constraint, a shortage of containers, etc., I think the growth would have been even more stronger. But despite that, we suddenly saw not just in China, but I think Singapore also released in December export figure stronger than expected. But again, the two sides. One is demand. The second, because we are reporting in dollar value on the export front, unit prices has gone up. I don't know about you. That everything has gone up, whether it's coffee, whiskey, or beer, or your Chee Chong Fun for that matter. So all these have add on to the value side, but we are hopefully seeing some degree of stability. The Chinese government a lot of Chinese economy were the first to be hit by the pandemic. They were the first one also to cut, and they are still, in that sense, cutting rates because growth had slowed down. And this morning, I think they trimmed one of the key lending rates slightly to add more liquidity. They have already trimmed on the reserve requirement to add liquidity to the banking system. So they're providing some support to the Chinese economy. So I'm sort of quietly confident that although momentum has slowed, second half of last year, combination of factors, supply disruption, property sector slowdown after excessive speculation had forced the government to step in. We'll likely see a more moderate growth path for China going forward, supported by I think the more accommodative policy. I think China is still okay going forward. There may be pressure points as the regulatory environment continue likely to remain tight, as they essentially want to make sure that smaller players still have a foot in a very exciting growth environment without the big, large player who had obviously started before being able to, they don't want monopolistic behavior to sort of keep other smaller opportunities benefiting, I suppose, other companies coming out from China. So I think China is still okay. Okay, next one, please. Okay, this is a description in terms of trade and industrial activities. Pick up somewhat. Again, as you see, it has cooled a little bit, but I think it's stabilized, which is fine. Here, what you can clearly see is that we do have that 10-year sort of a cycle in which the pandemic brought an end to a very mature growth cycle. Now we are starting a new one, somewhat wobbly at this juncture, but we will, I suppose, move on. Next, please. Okay, so this is again just a description in terms of economic activities from the as measured by the PMI quarterly one. As you can see, it was like bouncing all over the place. First half was fairly positive until the coronavirus flare-ups pull back in activities, especially here in the Asia Pacific region, in terms of the in-person activities being more restrained as a result of the flare in coronavirus. Recovery somewhat in 4Q, but obviously 4Q was affected by late in Q4 by Omicrons. So it may spill over to Q1. Will Q2 be better? But I think hopefully the second half will be more stable in terms of growth profile. Next chart, please. So this is just the description in terms of we had setback to the Asian recovery, but I will still say, this year will be more stable than last year. Yes, some countries are still facing significant headwinds as far as the ASEAN countries is concerned. But I suppose if the coronavirus, the Omicron doesn't prove to be too disastrous, I think we should be on a more stable ground. At the bottom there, I have the IMF will be releasing their new forecast, I think next week for last year and for this year. World Bank just came out with us on last Friday. It tweaked slightly last year as well as this year, but again for 23 they're more hopeful as well. So you can see the picture on that side. Okay, next one. In terms of how it can be volatile, here's an example, a forecast by Oxford Economics that I often use. Because of Omicron, we have certainly seen updates and changes to their forecast every month. November, tweak a little bit. December, tweak a little bit. When the January comes out, you will also, I would say, slightly adjusted as well. But the picture is fairly similar in terms of 2020, collapse in output, 2021, rebound, 22, hopefully, more steadier growth. After the rebound, more, a slower growth, but that's because of the base effect. And 23, more steady growth. Will that be the key? I hope so. Inflation is the one where obviously a lot more attention has been. There's more upgrade on the inflation front for various reasons. But I think, fingers crossed, that prices may have stabilized. We'll talk more about that in a little while. Okay, next one, please. So US, US, for me, if there's one thing I want to say clearly is that the US Central Bank were late in normalizing their interest rate policy. In Singapore, we adjust our policy slightly in October on anticipation that we are well past the pandemic stage. US, I think they're still overly cautious, even though we saw labor market condition steadily improving. It's not a straight line improvement, but generally it's improving. We see businesses and people spending. On the left side, this is the retail sales on year figures, obviously recovered well from the pandemic slump and holding at the level. It's still bouncing around, which is why on month figures can 1 month up, 1 month down, and on value terms, because things cost more, you do get prices supporting the total sales. If we look at the economy, is there still slack? There's still slack, although the slack is being taken up. Industrial output figures. Downside surprise in the December one, but again, as you can see, there will be the odd months of up and down, but the overall trend, as you can see, is still up. Taken together, I would have said, the US Central Bank should have moved end of last year instead of waiting, and the consensus forecast is for them to move at March. They can certainly also move in January, I would say. But I'm not running the US monetary policy. To me, they're still putting too much of a punch bowl out there when the economy is, well, I think, already on a recovery path, i.e. it's no longer as sick as what it was, so it doesn't need that kind of medicine anymore. Move on to the next one. So here we are, I think, just to wrap things up in terms of inflation. Is that going to be the tail risk that turned into the base case for the year? Certainly looking at one of the series that we follow quite closely, this is the PMI in terms of input prices and to what extent that get passed on to the consumer. It looks like it has peaked and turned several countries over there as far as the market survey pointed to. So if we were to take this, certainly suggest that perhaps prices are not come up in a big way, but at least stays elevated. We can go through the next slide as an example. I think a better example here in terms of less bad news. The WCI is the World Composite Index for freight rates. So as you can see, freight rates just shown, a steep line over the last year and a half, which or 2 years, actually more like 3, which is why the container liners were like ripping monies left, right, and center. Well, can't blame them. They had suffered more than a decade of difficult times, and the last couple of years were just payback time for them. And prices or costs to put your stuff on the boat is still very high. It's come up a little bit. Not just the cost of the freight rates, the cost of containers, which the China Containerized Freight Index, for instance, has also went up significantly. But again, there perhaps signs of moderation or just stability. The prices, though are still very high, is not going up as much as before, if there's any consolation in that. if we were to look at it year on year, a container cost or freight rate had gone up by triple-digit growth last year. Now it's double-digit. So instead of 100%, it's now 80% if there's any consolation. So we'll see going forward. But obviously, there are still pressure points because, again, China just last week closed its third port, I think Dalian, because of COVID cases. And as a result, we got pressure points. So supply disruption can still perhaps keep these freight rates. And for this month, it will still be high because Chinese New Year is just around the corner. So demand is very strong for goods to be shipped out before Chinese New Year. So we'll see what happens after Chinese New Year in terms of perhaps a better picture of freight rate and freight charges. But otherwise, we are still seeing the bottom one, IMF food prices, I can see, a record high, taper off a little bit over there. Coffee as well, as I was saying earlier, coffee prices are decade high, tin prices, etc. Good, not bad for some of the countries, commodity exporter, Malaysia, energy, palm oil especially also from Indonesia as well. So the rural segment has done well. So for those commodity exporters, Thailand, Malaysia, Indonesia, they certainly have benefited. So the government has been less vulnerable as a result of windfall gain from the surge in commodity prices. Can commodity prices still stay high? Possible. Next chart, and I think the last couple to wrap up. Next slide, please. Stuck. Okay, weatherman. So this is La Nina. As you probably all know, the weather has been rather cool recently. Actually, wet. La Nina, wet weather in Asia. The BOM, or the Southern Oscillation Index, really just a difference in pressure between mainland Australia and the Pacific Ocean, Indian Ocean. So if the reading is strongly positive, we get a lot of rain in this region. If it is very strongly negative, we get drought. In this region, we getting the rain. So you can see from this chart, the numbers are still persistently high. So that suggests that if it continues, which is why every other month I become a weatherman and check the website for what the weatherman says about the La Nina this year. They say it's still on, so it's wet. So supply disruption could still keep prices on commodity side high, whether it's palm oil, whether it's rice, etc. as well. So it may not rise further, but it may not come off quickly as well. So if that's any consolation, as I say, the inflation rate, let's say ours, which have gone up to 3.5%, may tweak higher over the next couple of months, or first half of this year. Second half, higher base of last year, it starts to come off. And this is where I suppose we'll see the profile of inflation in Singapore and the region next year. Obviously for Singapore, where it can come up again the following year is GST when they when GST rate get high, but we won't talk about that for now. Save it for next time. So that's basically it. With I think the last couple of charts are coming up. Next one, please. So what do we have? I suppose still a reminder again. The pandemic reset the growth cycle. It ended a very long one. A new one has started, very wobbly. Recovery after a pandemic year on year, very high. Last year, it essentially reflects the lower base. This year and going forward, will start to normalize. But as it normalizes, we'll see broader contributor to the headline growth. Obviously, export-oriented, etc., has done well. We have seen in-person activities still being constrained, so leisure travel and some of these services side still a drag. Hopefully, say tourism may not recover in any shape or form in a significant manner until 2025, for instance. So those may be when we start to see more broad-based quality recovery. But for now, I suppose we're starting to see. This is, again, as I say, hopefully the Omicron doesn't turn out to be too virus. Anything to touch up? I think the next slide is useful to pay attention to, because these are more in-person type of activities, whether it is Beijing Winter Olympic, whether it's Hanoi hosting the Southeast Asia game, or whether esports as part of the ASEAN game in Hangzhou in China, G20 or World Cup in Dubai. So these are in-person activities which, if we tick off, would then be a sign that we are heading towards a more normalized state as we, I suppose, are able to live with pandemic endemic stage itself. Elections around the region here, some more important than the others. Don't think they'll matter too much in the big scheme of things. President Xi Jinping will be going for his third term once every 5 years, Chinese Party Congress. Don't think that will be too eventful outside of that. So I think because of all these events, and if they take place, I would say, we are at least more comfortable about the year starting to look or resemble something more normal itself. Elections in Malaysia and Thailand, whether they come or not, may not matter as much as well, except if growth in the rest of the world picks up pace. Malaysia, Thailand, export-oriented economy will see a lift, and that will also help the politician in the respective countries as well. So these are a couple of things to pay attention to, but otherwise, we would say, okay, I think I can end on this slide here and pass it back in that we are on a new growth cycle. There are pressure points, but I remain hopeful. And the question beyond this point is, if Omicron doesn't prove to be too disastrous, so far it's more contagious, but not too disastrous, then with treatment hope, vaccinations rate picking up, etc., and as government can look to relax more, especially second half of the year onward, touch wood, then I think we are on more stable ground. And this is where I suppose your growth story comes into play more significantly. And but whether it's growth stock, value stock, I think I should pass it on back to Ben to pass it to Terence for a more exciting second half. Thank you.
Okay, thank you very much. So, really like the way you characterize your talk. Look, my face has disappeared. So certainly China is a big risk factor, along with the disruption due to COVID, as well as the supply chain and inflation is all wrapped up. We already have a question about that, but we're gonna talk about it later. So thank you very much for that, Song. So Terence Wong is from Azul Capital, and we're gonna pick his brain and get some of his insights on his take on the year of the tiger. So thank you very much, Terence, for joining our program today. I'm going to hand over the time to you.
Thank you, Ben. I'm just about, am I unmuted? Okay, I'm unmuted. I'm just about to fire up my slides. Let me know if you cannot see it. There we go.
Yeah, looking good.
Looking good?
Tiger,
okay.
Dragon, okay, yeah.
Okay, yeah. Since we're on this year of the tiger thing, and incidentally, my logo for the firm is an Azure Dragon, Qinglong, right? So, and the tiger and the dragon, they have, some relationship. And it really reminds me of the movie Crouching Tiger, Hidden Dragon, the hit movie in year 2000. And the meaning behind it, I think many people watch it, but they don't really understand what 卧虎藏龙 means. Really means ordinary looking people having hidden talents. And I think that our local market, SGX, is an ordinary looking market, but with many hidden gems. So I am going to share with you some of my thoughts about the market, just like I've done, over the past many years. Last year, incidentally, when I did a talk, not with Xias, but then when I did a market talk, I actually thought 2021 was going to be a very good year. I got the direction sort of right, but I think my main thesis was wrong. I mean, Uncle Song was talking about it just now, that, we were all hopeful that, that will be the end of the pandemic, we'll hit the endemic stage sometime in 2021. But of course, there were a few curveballs along the way. There was a start again, stop again, and this have really affected the market. And you can see some of the key events which actually cause the market to have certain stops, certain pauses. At the very start, the first few weeks actually looked very good. We really pounced on the market, gave a little bit of the, I think the games back towards the end of the first quarter. But then we started to have this whole vaccine exercise, and we passed certain benchmarks, 25%, 50%. And then very, very shortly, we were up to 60, 70%. By National Day, we hit the target of over 70% of it. But and that's when optimism started to flow in. But towards the third quarter of the year, there were concerns about, Fed, because we were successful in, potentially containing the virus. There were talks that Fed is going to step in. They were going to start to taper. They were going to try to withdraw the liquidity. They will try to taper the liquidity, and that affected the markets. And then later on towards the end of the year, or the last quarter of the year, where VTLs, we started to open up again, that was point of optimism. The market started to go on a rush until Omicron set in towards the later part of November, and the market went on a little bit of a tailspin before picking up again in December. And that's the year in general. We actually popped up maybe from the start of the year to the peak in November. We were up maybe 14-15%. And then after that, we ended off the year in high single digits, which was not too shabby, but it was not as we had imagined. STI did, I think, decent. We were right in the middle of the pack. We were better. I think we were better than much of the other Asian counterparts. But in terms of global, we compare against parts of Europe, of course, the US, which was on a tear, they did better. But generally, I think STI wasn't all that bad. In 2020, we lagged behind because the main contention was that, hey, there's no new economy plays. If you look down the STI, the 30 stocks, you'll be hard pressed to find any tech companies. In fact, I think you probably will have to look at guys like Venture, which is a manufacturing company, not a cutting edge technology company. So 2020, while the world was going, on a big upswing in the second half of 2020, we saw some growth, but it was fairly muted vis-a-vis the global indices. So that swung back to value plays at the early part of 2021, and I think we actually rode part of the upswing. And in terms of the valuation, the forward valuation of the market, it is not exactly expensive. We are below the average point. The average is probably about 13 plus times. But currently we are trading just above 13 times PE. At the end of last year, it was 12.3, 12.4 times. We've seen a little bit of a rebound in the market, and we are still below average when it comes to the valuation, the forward PE of the market. And earnings growth is expected, since the economy is expected to, firm up the next couple of years. I think in terms of the earnings growth, it looks decent. We're not seeing phenomenal one. In 2021, guess what? We grew by over 50%. If you're looking at some of the counters, or if you're looking at the blue chips in Singapore, and that is because in 2020 was an extremely low base. It was unfathomable. I mean, the kind of base that we've seen was very, very low. So to jump 50% was really very much within reason. And then now that we've hit, I wouldn't say a high, but we hit a much higher point compared to 2020. At the 2021 level, we are still expected to grow 15% when it comes to earnings, and another 12% in 2023. So if you look at the P ratio, the P to growth, it is still below 1 time. Some factors to consider, and some of that was picked up by Song earlier on. We have inflation, and it really is determined also by the Fed hikes, and the Omicron variant obviously is one of the key things. But the way it looks is that many people are getting infected. Fewer people are actually getting going to the ICU and getting into serious conditions. So it's not as bad as we've expected, and this may be one step towards walking towards endemic status. China slowdown, that's something that we have to watch out for. President Xi Jinping has made many moves recently, and really it is meant for long-term gains. But in the short term, it's a big question mark, and many companies and many different sectors are seeing an impact because of that. And geopolitics, and this started, I believe, all the way back in 2018 when the US filed the first salvo against China, and really this US-China tension has continued on. And I believe that there are actually beneficiaries to that. So, but it is not only China versus US. There are also many other potential flashpoints globally that can lead to a weakening in the financial systems. Some unique drivers, I think, to Singapore, you've seen it coming. There are 3 SPAC listings. SPAC was actually, I think the idea to have SPAC in Singapore really went on, there was really a big conviction, like only starting last year. There were talks previously, but then last year there were very serious talks because SPACs had really taken off on the Nasdaq in 2020 and in 2021. The amount raised was like over $100 billion, and many of them were talking about tech listings via SPACs. And given that, remember earlier on I was saying that Singapore being a very traditional market that had everything, in the old economy and nothing in the tech space, the real tech space. So this was actually one ticket that we are using, and one important ticket that we're using to actually leapfrog and accelerate the number of new economy listings. And already we've seen 3 listings or potential listings going to be this month. But the one that's Vertex backed by Temasek is going to be very closely watched. Then there's Pegasus, also some Temasek money, and I believe Novo Tellus will all be coming out this month. I think SPACs will be an important part of the entire ecosystem, even though it is very new. And as part of the improving the liquidity and getting more interesting companies to list, the various agencies, government agencies, have also come together, including Temasek, EDBI, SGX, and MAS. They have come together to actually create this ecosystem, and Temasek and EDBI have set up $2 billion of funds to attract new economy listings. Under Temasek is called 65, and that goal, I think, really come into add excitement to the system. SGX's role is to create liquidity. So they do have certain liquidity providers coming through to actually help boost the market, especially of these new listings. So I think that's quite interesting to watch. Now I'll just move on to some of the different sectors within the SGX, some of the more popular ones. And then when you want to delve into some of the other ones, we can save that for Q&A. One of the big things or sectors is always property. Over the last few years, if not the listed space, the listcos, it is largely going, people are always talking about the physical property. And, we have been fire. Over the last 1.5 years, the private property index went up by 8%. HDB, well, even bigger fire. We're talking about 14% increase. And the transactions in the total primary market, we're talking about close to 15,000 units, while the secondary market is over 21,000 units. So all in, there's 36,000 units, and that's the best since 2013. And, as the numbers started to be flashed out month after month, these positive numbers, there were worries that, the government is going to come in with cooling measures, especially, and then in December, mid-December, while we are just about to celebrate Christmas, that measure came in. And that, we thought it will rock the property guys. It did, for a couple of days. And then it started to fizzle out. There wasn't the very hard crash. In the fourth quarter alone, and it's not surprising to see why, because in the fourth quarter, you see the private residential places going up by 5%. the quarter, and the rest of the central region was up 7.3%, right? It's no surprise that and so really there's no surprise when the government came in to heighten the ABSD and lower the TDSR. And this is a look at some of the price indices. It has really like gone up, whether it's at core central, the rest of central, or the outside central regions. All of them have seen a significant rise, all the way since the last crisis. Some of the property stocks measures will be felt, like I said, in the short to mid-term, but I think the impact wasn't as significant as many of the past measures. But if you look at the physical stock itself, in 2013, and again in July 2018, I remember that the transactions on average fell 2,000 units the next quarter. So it was, on the physical front, it is quite a hard hit. But on the stock front, it may not be as serious. Because if you look at the developers currently, they are trading at 0.6 times price to book, which is already at recession levels. There are certain reasons why property guys have not found favor amongst investors. But this year, if you look at the transaction volume, that I think can fall by 30 to 40% this year. That's quite drastic. That will be a dampener to property stocks, but I don't think that you will see a significant shock. Unless there's like series of property cooling measures that will really not only curb the market but kill the market, which is unlikely. So many of these property developers are really, the big ones are sitting at a discount of about 30%. The smaller ones are discount of 50%, and that is just the book value. If you look at the revalue NAV, we are talking about a discount of anywhere between 50% and 70% for some of the smaller developers. So I think in terms of share price, we are there, if we're not almost there. REITs is another very popular vehicle, lackluster in 2021, because there's been many of the REITs have found big favors in 2020, particularly the industrial REITs. There's some rotational interest that happened in 4Q 2021. They are looking at retail, office, hospitality. They are trying to look for the subsectors that were underperforming. And like say hospitality, they're really trading below book value. You'll be hard pressed to find any other subsectors they're trading below book value, with the exception of hospitality. And I think investors are generally hoping or looking forward to the day that Omicron gets, wiped out or, been forgotten, like just a part of life. And that is when hospitality stocks will start to rebound. There'll be more traveling. And I think that, many people are gearing up, preparing to travel. And that is going to be positive for hospitality stocks. With REITs, I think that, you've got to be still selective. Look out for some of the more interesting subsectors that you can benefit from instead of like buying every REIT. Currently, the average yields is not too shabby. It's still about 6%. And given that the 10-year yields, I think currently it lies about 1.6 going to 1.8%. So the yield spread is still fairly decent at just over 4%. This is a look at the REIT performance. Banks. Well, banks, another sector that did very, very well. I think single-handedly they pulled the STI up last year, and they continue to be very, very interesting and to find favor. And many investors are actually very, very excited about it because of rate hikes. And rate hikes are good for banks because if you look at the net interest margins, they'll improve as banks reprice the loans, and the fee income. There'll be a boost as with more reopenings, people are traveling, there'll be loan fees, transaction fees, credit card fees. There will be numerous ways that people can benefit from. There's also the wealth management side, which I believe that investors or the banks are now individualizing, they're basically like calibrating all these product offerings, and I think that that's going to be very, very positive for the mass market wealth segments. The banks, even though they have run up quite a fair bit, they still trade about 1 to 1.4 times price to book, very reasonable compared to the international, the global, even the regional banks, right? But having risen up so much, I think that should there be a market pullback, the banks, given that they have a lot, they have like given a lot of profits to investors, they'll be on the first step. Investors will take profit from, if you look at if there should there be a market pullback, right? But otherwise, if you look at valuations itself, like I told you, 1 to 1.4 times, not expensive compared to its peers, and the dividend yields are also I think attractive at 4.6 to about 5.8%. Technology in 2021, it was really a tale of two parts of the technology chain. If you have the upstream players, you'll be laughing to the bank, you'll be very, very excited about the numbers. But if you are somewhere downstream, there'll be you will see largely lackluster performance because of components shortage, and the situation seems to have exacerbated as like moving into the Christmas season. So many of these tech companies, even though, or the manufacturing companies, even though they have orders, but they are not able to deliver on time. There's still waiting time for the chips, the very important component that powers all technology products. The chips, the semiconductors, the waiting time is still very, very challenging. We're talking about north of 24, 25 weeks wait. And that actually has an impact on the downstream players. But I think that will ease in the second half of 2022. There's some, I think, quite interesting tech-related plays in Singapore. You don't have to wait for the specs to come on stream. Oil and gas, I think the crude oil prices, have remained largely elevated. It will remain largely very elevated in the near term because of the demand supply imbalance, right? The supply growth is hit by underinvestment over the years, especially in 2018 during the markets are so bad, right? Even before 2020 when coronavirus hit, it was already coming off significantly, and there's understanding there, and that has impeded supply growth. In terms of demand, it has grown tremendously after the economies opened up somewhere in the second half of 2020. So we are playing catch up. Remember not too long ago when the whole world was locked down, the prices for crude oil actually went below zero. You are being compensated for holding oil, but that seems so far away right now. And with this high oil prices, there's going to be higher capex by the oil majors, by the national oil companies. That will benefit asset owners, oil service providers, and shipyards in general. And if you look at the shipyards in Singapore, they are trading below 1 time. Again, if you compare against the peers in South Korea, in China, South Korea is going north of 1 time price to book. In China, it's 2 to 3 times. So again, I think that some of these oil and gas players, some of the shipyards are trading quite attractively. With that, I'll end my talk and then I'll open the floor to questions. I'll pass it back to you first, Ben.
Thank you very much, Terence, for that insightful presentation. So lots of sectors they've covered. Actually, it does coincide with some of the questions we already have. So in the interest of time, we're just going to kick off with the questions. Okay, the first question is about, can I invite Mr. Song to turn on the, okay, that's good. All right, thank you very much. So the first question is about the prices of commodity and electricity. So when do you think the prices of commodities and electricity might fall? Could I invite Mr. Song to answer?
Fall?
Yeah.
2023, perhaps, but even so, we got GST coming soon. Okay, very simple. given where prices are today, at the end of Q1, when we revise for the next quarter, it'll still be up. If, as I agree with Terence in terms of an oil market, there's the imbalance over there. Whereas, the few years of under investment in the energy market, plus just the demand recovery now adds on to upward pressure. And obviously, it doesn't help. Depends on which side of the environment issue you're coming from. In that, with the green environment sort of a movement still very strong, it's also very challenging for even industries, they say the shale gas in North America to come back in a strong way as well. So I suspect the oil imbalance will persist over the near medium term, and near medium term easily the next year or so, which then keep prices elevated. Could prices goes beyond the current, let's say $80, $85 upward? We have to be seeing very strong demand recovery. At the moment, I think not just there yet, but more upside than downside. So simply put, for the answer, my take would be less likely to see, you and I paying less for our utility bills anytime soon, or certainly over the next year or two, maybe 3 years' time, let's say.
3 years? Okay, all right. That would be the year of the what? I don't know, dragon.
It's okay. You and I, we still have, hopefully, if our bosses are listening in, a little bit of pay increase to come along. But since Terence is the boss, he has to pay more for his workers or his employee. So they will be happy as well. So I suppose it's a case of to what extent inflation expectation keep pace, but the rate of growth should slow down. If, again, as I say, if there's any consolation, US CPI currently 7%. It may halve, but it's still higher than, in that sense, what they're used to at around 3%, essentially being supported by still elevated prices, not just at the commodity level. In the case of the US, it is home shelter, which is why we have seen, coming back to what Terence was talking about earlier for elsewhere, home prices essentially are still climbing in almost most part of the world. We had our cooling measure. China had introduced theirs as well. So maybe the biggest one and the smallest one may see more housing price stability, but elsewhere may be quite challenging.
Okay, all right. Okay, so I guess I should be using less of the aircon, I suppose.
I'm so cool, you don't need aircon now. I haven't turned on my. This is the other side. My icon man say, "Hey, can I come and fix your aircon?" There's nothing wrong with it. So never mind, just come and service. I also happy at least there's comfort in knowing that if I turn on the aircon, it will still be cool, even though I haven't turned it on in a while already.
Then you should be wearing less.
Sorry,
you need less aircon.
Yeah, need less aircon.
Yeah.
Okay, the next question is about, when will the prices of the 3 local bank stock go up further? And I'm going to pose a question to Terence, since you had that slide about the banking sector. So what's your take on this? I mean, they've had quite a good run, right? So,
7 straight session of gains. People are asking me, "Hey, how DBS $35?" Okay, now I say, "Terence, how DBS $35?" Oh, see, you will be $30.
Yeah, it's past $30. Yeah,
there we go.
I mean, it seems there's some really amazing growth, and it is not unfounded. I think that if you look at the reasons that flashed out earlier on, you're going to see some very good numbers coming out from the banks, right? And the banks itself, the cool thing about it is that they're also generating very good cash flow, and banks like DBS, they are reverting back to quarterly dividends, right? And so it's even better than the REITs. So they're giving out 5+%, and you've got this optionality of good growth in your stock price. I think one of the brokers have raised the target price to $40 already, and if you look at the valuations, it is still relatively attractive. For DBS, it's the highest of the three. We're talking about 1.4, 1.5 times price to book, but still compared with its global peers, it is still cheap. The other two are sort of like, I mean, UOB, I think it's at 1.2, 1.3. OCBC, it lags behind. I don't know if it's because of the phishing scam, but the lagging part came before the issues. But I think some of the bank investors are trying to do some rotation because they said that they're going to like switch from the outperformers to the laggard because they think that it's a rising tide that lifts everything. And there's only like 3 banks to play around with in Singapore. Whatever the case, I think that this year should be positive for them. But I wouldn't think, but I think that even though they are cutting rates, it wouldn't be automatically like, boomtown for all 3 banks, like what we've seen over the last 1.5 years. Last 1 year, we were hoping, and this hope has led to the prices going up. And now when reality sets in, that could be a time where, investors will take some off the table. While I think that over the year, there will be appreciation, but there may be some rough times go ahead. So if you want to pick it up, may not be the best time because everybody is slapping it on. If there's a Capricorn effect at the start of the year, the people are saying that, wow, it's going to be a great year. So they start to pile onto the banks. But I do believe that there may be a better time to pick the banks.
Okay. There is a pointed question about DBS because DBS is, I think, trading at price to book of 1.4 times. So the question is, in your perspective, do you think DBS is overbought? As it is, the price is already too high.
Like I said, that it depends on how you compare. You compare against the other two, like some of the local investors. Then that's why there's some form of switching around. But DBS have traditionally been high, and last year there were times where DBS were also flirting or hit the 1.4 times, whereas the other two are close to 1 time. But it continued to rise because they actually validate the numbers through its earnings. So it has grown tremendously, right? So it's really a function not only of the current price to book, but also whether their earnings will outstrip the other two.
Okay.
I suppose it also is if you sell DBS, what do you buy?
That's true.
As well. Anyway, questions.
I don't know, Bitcoin. I mean, it's hovering around the 40K. Okay, different topic. Sorry to interject, gentlemen. Okay, back on the topic, we have another question about the REITs. All right, so REITs, as we know, is most of the funding comes from debt and all that, and obviously the REITs in Singapore have restructured that in quite an efficient way. But the concern now is that interest rates are going to be the headline story in 2022. There's probably going to be more than one happening for the US. So how is that going to affect the REIT sector in Singapore? Is that going to be a dampener? How is that going to pan out?
Well, I think the simplest level will be yes. The increase in rates will have an impact because with REITs, we are just not talking about the absolute yields, the DPU yields, right? As I said earlier on, it's circa 6%. But it's also the spread between the risk-free and the yields. And currently the spread is, maybe about 4.4, 4.5%, which is high compared to previous years. But this gap is going to close. And the thing about investments is that we don't wait for the gap to close. The expectations of it closing can have an impact and will have an impact on the REITs, right? So that's why even though I think that many of them are trading at decent levels, there is still cause for concern. When the gap starts to close, the yield spread starts to close, then people will start to sell first and think later, right?
Okay. All right. Let me see just very quickly. Okay, specific question about the palm oil sector. Companies like Wilmar, Umitama, Agri, so on and so forth. The share price have not been reflected in the ever escalating prices of palm oil. So what's happening there? Are these companies still viable investment venues, or but why is it not moving, the prices?
Palm oil. Okay, Song, do you have any views on palm oil? You were talking about commodity prices, right? I think that it looks like it's gonna appreciate. I mean, we spoke about the weather, the La Nina and all, right? That will likely appreciate. This I think, like I said, I don't really look at plantation players, but Wilmar is one that probably can be interesting, not only because on the palm oil front, but also because they do have very, very sizable presence in the likes of India, in China, with regards to their business. And in India, I think the likelihood they will be looking to list the subsidiary, and this will actually add on to SOTP. But of course, investors do have to be cautious, because when they did the China one, a lot of people were thinking, well, it's going to start to shoot through the roof, but it didn't. It went the other way, right? So I think with commodity guys, it's going to be positive, but I don't really look at them, in specifically, because I think it's very, very difficult. Not within my radar.
Right. Okay. I guess from an academic perspective, and I just can't help myself, is that the price movement of commodity companies like ExxonMobil, Golden Agri, Wilmar, versus the underlying products that sell, like palm oil or sweet crude and all that, the correlation is actually relatively low, if you look at it from numerous studies. So it doesn't mean that when oil prices double, the share price will double, right? I think this could be a case here where the palm oil prices have been escalating due to seasonal factors, as well as higher demand or reversion to the mean. But the prices of the companies themselves have not moved. So as you can see, the correlation is not one for one. So a lot of times it could be because of the way the company is run. Right, the margins are not great. It could also be because of governance issues. And of course, was it 2 weeks ago, there was an issue with one of the commodity companies in Indonesia, I just forgotten, where they had an export ban, right? I just forgot what's the name, right? So they couldn't sell their products outside of Indonesia. So, there are other things out there which are actually affecting the stock price rather than so that means it doesn't track the underlying price very closely. Okay. All right. So maybe for Song, what do you think about gold? What do you think is the forecast for gold for 2022? Are you a gold man?
Well, it glitters, I suppose. That only it matters. I suppose again, it doesn't yield interest, but I think because risk remains on the table, irregardless, it continues to be a safe haven from that perspective. So I suppose it's a case of market participant essentially using gold. Yes, it doesn't yield interest rate, but it is a haven from which people still flock to when there's period of uncertainty. So I think this is where it still remains. So come down and up, obviously, will be driven by where dollar is, and this is where direction of the dollar impact commodity prices, which are still generally priced in US dollars. So this is how I think will still play out in the coming months. In that it is still there. A lot of the direction will be driven by US dollar and where the dollar is heading to.
Okay.
I don't know whether Terence have something more to add to that.
Well, I mean, given that both of us spoke extensively about inflation, it is a great inflation hedge, and I do think that there will be some interest in gold sometime in 2022, right? At the start of the year, there's a lot of equity, people going to growth stories, but I believe there will be some switching out, when they look at the inflation numbers being fleshed out, if it persists, I think that this will be going to be a good year for gold.
Well, I mean, certainly gold is, from a technical analysis perspective, is on an uptrend, at least on the recent few weeks or months. But if you compare gold to 6 months ago, it has been doing terribly. It's been a bit boring, right? Okay, so we'll see how it goes. Certainly, we might get back to the traditional definition of gold as an inflation hedge and safe haven. Again, it depends on what happens on the Ukraine-Russian front. Not sure. Okay, time now is 1:29. Let me just run through. Okay, what is your view on the Pegasus spec?
Me also.
Aaron, it's all yours.
Okay. Well, you see, I'll take this final question. With the spec, I mentioned earlier on that 3 of them right now, right? Vertex, Pegasus, and Tellus. And really, what it boils down to is what the D spec is going to be, the target company. And all of them, they do come with very, very powerful credentials. Like I said, Vertex, I mean, they do have a long history of being in the PC world. Pegasus is like, they have basically LV Money, and Temasek is also in there. The one who was running it, he was from SG before, and he does have a very, very good track record. And over Tellus, there's Loh Wai San, right, who's of AEM fame. So whether it's a Pegasus or like say Vertex or Tellus, really, you have to, right now you don't have anything but the track record of these people, right, to bank on. And you know that being the promoter of each one of them, being a promoter of a spec, they do have to find good vehicles to de-spec. And then because they would have a big economic interest, at the end of the game, they're gonna retain 20%, or they're gonna have 20% of that company for putting the risk money down. And I think that, you know, all 3 really, I think we're starting off on the right track. There should be fairly good interest. There are many tech companies out there, and these tech companies, you know, and they're potential unicorns, right? There are some very good companies in Singapore or in the region that are potential unicorns or already unicorns. And this really gives them that vehicle to ride on. So I'm waiting excitedly. I'm waiting at sidelines looking at what they have to offer.
Okay. Well, certainly the specs right now, I mean, the first one is going to be listed on the 21st, I believe. So certainly is a bit of a black box, because obviously they've not even done the IPO, let alone talked about their target acquisition. But it is quite exciting, I suppose, because if it's Temasek back, they might actually have already an opportunity in mind in terms of the portfolio companies, right? Because Temasek invests in a lot of private different companies.
Actually, I believe that most of them would have something in mind, right? They've not inked it down. They can't.
Yes.
All right, but there are options already.
Okay, and I suppose it's going to be fairly interesting,
Yeah.
rather than Benjamin go pow cha shop or something. That would be
Well, you can try.
That'd be more excitingly, you know.
Yeah.
you can try. All right, maybe I should try. Okay, so the time now is 1:32. Unfortunately, we have ran out of time for this week's session of the Weekly Market Review. I would really thank our 2 guest speakers today. So Mr. Song Seng Woon from CGS, CIMB, as well as Terence Wong from Azure Capital. Thank you very much for a very insightful presentation today. I think it's very helpful for people, or rather, members of the public, to kind of get a sense of what the year of the tiger might bring. So thank you very much for joining us today. Very appreciative for your presentations.
Thanks, Ben. Hey, thanks, Song. Hey, see you.
Happy New Year, everybody.
Happy New Year,
catch
everyone.
up after that. Thank
Okay.
you.
We need to arrange for something, right?
Yeah.
All right. All right. So
See
thank
ya.
you very much.
Okay.
So for our participants out there, or rather people who have tuned in, so have a great week ahead. And we will see you again next week, Monday.